let's start with Netflix. First quarter profits came in higher than expected. They added 2.2 million subscribers. That's more
in the U.S.
In the U.S., they were expecting 1.8 million. I mean, on balance, this looks really good, and yet the forecast that they gave was a little bit weaker than some on Wall Street were expecting, and that, as much as anything, appears to be sending the stock down 10%.
Yeah, well, Wall Street is so much focused on forecasts and what the next quarter is going to do that I think this is actually a really good opportunity if you're interested in investing in Netflix and either have a smaller position than you might want or no position at all, because down in the 90s and heck, if we're lucky, down in the 80s would be a great place to buy shares. And my broker's headline feed this morning was just saying, reiterating, every analyst out there is saying, reiterating target price 120, target price 130. I mean, that's where these guys are headed. And so if you can buy it in the 90s, you're going to do pretty well.
We were talking about this earlier, Jim. I was confused. Maybe I shouldn't be confused. After doing this podcast for 5 years, I should no longer be surprised by short-term thinking on Wall Street. But part of, I guess, the bear case, if you will, had to do with their international growth,
yep.
Not really being, and yet, was it just 3 months ago we were sitting here talking about how they had hit all of these international markets that they weren't projecting, initially they weren't projecting to hit them for at least another year or two.
At least. Every market they've gone into, they've done better than they expected. Canada, their first international launch, they reached break even like a year ahead of schedule. And they're saying, oh, we got something going here. And then Latin America, where they got 20 or 30 countries all at once, I'm of the opinion that fell in their lap because they had been planning to go elsewhere at that time. And that started out a little bit rocky. They had some payment issues. That might be part of what's affecting the latest 130 country launch. The payments are in U.S. dollars and limited only to if you have a credit card that can handle U.S. dollar transactions. So that might be slowing things down and some of the headwinds, but they're going to work through it. Latin America is a great growth story now for them. All these new markets are going to be a great growth story 4, 5, 6 years down the road. And as longer-term investors, that's where we should be looking. That's where Reed and David Wells and Ted Sarandos, all the chief guys there, are looking. They're looking several years down the road. They're not interested in the next quarter. They're saying this is a 10-year game, folks, and we're playing for that.
Charlie, when you look at what's playing out today in terms of the sell-off, what goes through your mind?
I'm very impressed by not just the quality of the original content that they've been able to make, but the pace at which it's coming out. I mean, you remember just a few years ago, they weren't doing anything. And, there's a lot of skepticism about whether Netflix can actually come in and make high-quality TV shows and movies. And I think that's been answered with a resounding yes. And it goes way beyond some of the, high-profile prestige programming like a House of Cards, and you go down the list into like the Aziz Ansari Master of None, the Unbreakable Kimmy Schmidt, all the kids programming, the stand-up comedy. They've got something for everybody in the family, and it's coming out every week. And I think, to Jim's point about thinking long-term with the company, I think that's what people should be focusing on, is that they've been able to make a lot of their viewing consumers happy with all this content they're making. And, the library is just remarkable in my opinion.
And so that raises in people who are thinking bearish on the company, well, all that great content is costing them a lot of money. And for the original content it's all paid up front because the actors and directors and the set people want to be paid, right? There's a big cash spend up front. And so that's why their free cash flow is so bad right now. But there was a telling comment by, I can't remember which of the executives said it. It says, your costs are going up, but our revenue is going up even faster. And that's being shown in the U.S. If you look at the improvement on their contribution margins over the years, that's the cost versus the revenue. And the revenue is growing faster than their costs. And that's what's happening. And that will begin to kick in internationally as the company continues over the next several years.